Imagine two people walk into a store to buy a refrigerator, same model, same manufacturer, same day. One person pays cash, the other person doesn't have that option. So they finance it, make payments, pay interest, pay fees, maybe miss a payment because life happened. And by the time it's over, the person with less money ends up paying significantly more for the exact same refrigerator. Same product, different reality. Now imagine two drivers get a flat tire. The first driver has savings. It's annoying, a hassle, bad afternoon. The second driver does it. Now it's a crisis. The tire gets replaced with a credit card or payday loan, or it waits another week because there isn't enough money. Maybe work gets missed. Maybe a bill gets paid late. Maybe an overdraft fee hits. And suddenly, a flat tire isn't a transportation problem, it's a financial avalanche. That's the thing about being poor. Most people think the hardest part is not having enough money. And don't get me wrong, that part is pretty difficult. But what most people often miss is what happens next. Because in America, having less money frequently means you're paying more money. The poorer you are, the more likely you are to pay higher interest rates, more fees, more penalties, more overdraft charges, more late fees, more financing cost, more for basic financial services, more for transportation, sometimes even more for groceries. And here's the part that should make people uncomfortable. Many of these extra costs are completely illegal. They're built into the system, not hidden in some secret conspiracy, not buried in a dark alley somewhere, out in the open every day. Think about how strange that is. The people with the least financial flexibility often pay the highest price for everyday life, while the people with the most financial stability often receive the discounts, the rewards, the lower interest rates, the better terms, the better options. And before somebody says, well, Derek, that's just how risk works. Sure, sometimes it is, but that's not the entire story. Because tonight, we're going to look at something bigger, a pattern, a system that often punishes people not because they made a bad decision, but because they ran out of margin. A missed paycheck, a medical emergency, a car repair, a job loss, a family crisis, one bad month, one bad week, sometimes one bad day. And suddenly life becomes dramatically more expensive. Because that's the secret most people never talk about. Poverty isn't just a lack of money. Poverty comes with fees. Poverty comes with penalties. Poverty comes with interest. Poverty comes with waiting list. Poverty comes with worse options. And the result is a cycle that feels impossible for many people to escape. Not because they're lazy, not because they're irresponsible, because every step forward costs more when you're already behind. Tonight, we're talking about the poverty premium, the hidden surcharge attached to financial instability, how America charges people more for having less, why rich people often get discounts while poor people get fees, and how we've built systems that sometimes make it harder to climb out than it was ever to fall into. Because if hard work is supposed to help people get ahead, we should probably stop charging them extra for trying. Let's begin. Welcome back to Hold 'em Accountable. I'm Derek Holder, retired Marine, political troublemaker, and somebody who has spent enough time living in the real world to know that being broke is expensive. And if that sentence sounds ridiculous, that's because it is. Think about it. If somebody told you there was a store where the prices went up when customers had less money, you'd assume it was a scam. If somebody told you a bank charged higher fees to people who could least afford them, you'd probably be angry. If somebody told you people with fewer resources routinely paid more for the exact same products and services, you'd think the system was backwards. And yet, that's exactly what happens every day. This episode is not about welfare. It's not about handouts. It's not about whether people deserve help. It's not even really about poverty. It's about math, bad math, a system where financial instability creates additional financial penalties, a system where lacking money often becomes the reason to spend more money. Once you start seeing it, you see it everywhere. You see it in banking, You see it in housing. You see it in transportation. You see it in lending. You see it in insurance. You see it in the grocery stores. See it in healthcare. You see it in almost every part of modern life because the system doesn't just charge people for products, it charges people for risk. And when you're financially struggling, everybody sees risk. The bank sees it, a lender sees it, landlord sees it, the insurance company sees it, the utility sees it, and the employer sometimes sees risk. And every one of those institutions has a way of pricing that risk into your life. The problem is that risk pricing sounds reasonable when you're talking about spreadsheets. It feels very different when you're talking about people because eventually what you're really saying is the less money you have, the more expensive life becomes. That's where the anger should start. Not because businesses need to make money, not because lenders shouldn't evaluate risk, not because consequences shouldn't exist. The anger should start because we've built a system where a lack of margin often becomes a penalty all by itself. Let's say two people apply for the same job, same qualifications, same experience, same interview, same work ethic. One gets hired, the other doesn't. Not because they lack the skills, not because they failed the interview, because a credit check revealed past financial problems. Maybe it was medical debt. Maybe it was a divorce. Maybe it was a layoff. Maybe it was a rough year that spiraled into collections. Life happened. And now the very financial struggles they're trying to overcome become the reason they've lost an opportunity to improve their situation. Think about how backwards that can become. You need a job to improve your finances, but your finances can sometimes become the barrier to getting the job. You need housing to create stability, but your financial instability can become a barrier to get housing. You need affordable credit to recover from a setback, but the setback itself often makes credit more expensive. That's what makes the poverty premium so frustrating. It's not that being poor costs more. It's the system often places extra obstacles in front of people trying to stop being poor. And once you start noticing those obstacles, you see them everywhere. And that's really what tonight is about: consequences, the hidden fees attached to financial instability, the ways America quietly charges people extra for being broke. Because most people think poverty is about income, but income is only part of the story. The bigger story is what happens after the money runs out. And the truth is, America has been finding ways to profit from financial vulnerability for a very long time. Long before payday lenders, long before overdraft fees, long before credit scores, long before rent to own stores. The idea itself is older than most people realize. That's where we need to start because the history of poverty premium tells us a lot about why it still exists today. Let's go back. One of the biggest myths in America is that the poverty premium is something new, that somehow payday lenders, overdraft fees, and rent to own stores invented the idea of making money from financial hardship. They didn't. They're just the modern version. The truth is, America has been finding ways to profit from economic vulnerability for a very long time, long before credit scores, long before debit cards, long before online banking, long before most of the institutions that we recognize today. Because throughout history, there has always been one thing people with money understood: financial instability can be profitable. Not because poor people have more money. Obviously, they don't. Because people with fewer options often have less bargaining power. And less bargaining power usually means paying worse terms. Let's start after the Civil War, particularly throughout the South. If you really want to understand how financial traps work, you should study sharecropping. Because on paper, it looked like an opportunity. A person could work land they didn't own, produce crops, build a future. But the reality was much often darker. After slavery ended, Southern landowners still needed labor, and many newly freed Black Americans needed work, land, and a way to survive. Sharecropping emerged as one of the systems that filled the vacuum. In theory, it allowed workers to farm land in exchange for a share of the crop. In practice, it frequently became a debt trap. Many formerly enslaved people found themselves borrowing for seed, borrowing for equipment, borrowing for supplies, borrowing for food, borrowing simply to make it to the next harvest. And because the landowners or merchants often controlled both the credit and the accounting, escaping the debt became incredibly difficult. Now, here's the part that matters for tonight's story. While Black Americans were often the primary targets of these exploitative systems during Reconstruction and beyond, the trap didn't just stop there. Over time, many poor white farmers found themselves caught in the same cycle. Different backgrounds, different histories, same debt, same dependence, same inability to get ahead. The old system of slavery was gone, but in many places, a new system emerged where debt could accomplish some of the same economic goals, keeping workers tied to the land, keeping workers dependent, keeping workers from accumulating wealth. Again, different century, same pattern. Financial vulnerability became a source of profit. And as America industrialized, a different version of the same idea emerged: company towns. The workers were different, the industries were different, the mechanism was different, but the power dynamic looked surprisingly familiar. The employer wasn't just your employer, the employer was your landlord, your utility provider, your grocery store, sometimes even your bank. And when one institution controls both your income and your expenses, getting ahead becomes difficult because the game is no longer being played on equal footing. The company store became legendary for a reason, because when workers had limited alternatives, prices could become inflated, debt could accumulate, dependence could grow. The worker wasn't just earning a paycheck, the worker was trapped inside an ecosystem. And before somebody says, well, that sounds ridiculous, remember that Americans literally created songs about it, stories about it, labor movements around it, because people understood exactly what was happening. The details change, the pattern doesn't. Fast forward into the 20th century. Now we start seeing another chapter: redlining. This one is one of those subjects that make people immediately uncomfortable, which is usually a sign it's worth discussing. For decades, entire neighborhoods were effectively cut off from the same financial opportunities available elsewhere: mortgages, loans, investment, home ownership opportunities, generational wealth. Access wasn't distributed equally, and the long term consequences of those decisions are still visible today because wealth compounds, but so do missed opportunities. And here's why that matters for tonight's conversation. When people are denied access to affordable financial tools, they don't stop needing financial tools. They just end up using more expensive ones. That's a pattern we're going to see over and over again throughout this episode. Then came what many experts now call banking deserts: communities with limited access to traditional banks, limited access to affordable credit, limited access to mainstream financial services. And nature hates a vacuum. Markets do too. So when traditional financial institutions pulled back, other businesses stepped in: check cashing services, title loans, payday lenders, alternative financial products. The problem wasn't that they existed. The problem was often the terms. Because when your choices are limited, you're not negotiating, you're surviving. And survival is expensive. A lot of these systems were built because there was money to be made solving a problem. But sometimes the solution creates a new problem, and then that problem becomes profitable too. Think about it. A person can't access traditional credit, so they use a high interest alternative. The high interest alternative creates financial strain. The financial strain damages credit. The damaged credit makes affordable borrowing even harder, which increases dependence on the expense of borrowing. Round and round and round it goes. And here's the part most people miss: the poverty premium isn't usually one giant event, it's death by 1,000 paper cuts. A fee here, a penalty there, a higher interest rate, a larger deposit, a financing charge, a late fee, a missed opportunity. None of them seem catastrophic individually, but together they create a system where struggling financially becomes incredibly expensive. And that's why this issue matters, because when most Americans hear the word poverty, they think about income, how much money someone makes, what they earn, what they don't earn. But increasingly, Poverty isn't just about income, it's about access to affordable banking, access to affordable credit, access to transportation, to housing, to opportunity itself. And when the access disappears, the costs start piling up. Because what we're about to see is that many of the most expensive penalties in America aren't aimed at people who can actually afford it. They're aimed at the people who can't. And once you start looking at the modern economy through that lens, the examples become impossible to ignore. So let's talk about how we got here. By now, a pattern should be emerging. Different centuries, different industries, different institutions, the same basic idea. When people have fewer options, somebody eventually figures out how to charge them for it. And before anybody gets defensive, let's be clear. Not every fee is unfair. Not every lender is predatory. Not every business is exploiting people. This isn't just one giant conspiracy. It's something much more powerful, incentives. Because incentives don't require villains. They just require a system that rewards certain behavior. And for decades, America has built systems that often reward charging more to people who can least afford it. The modern version starts with something most Americans barely think about it: credit. Because credit isn't really a measure of how responsible you are, it's a measure of how lenders perceive risk. And once risk enters the conversation, prices start changing. A person with excellent credit applies for a loan. They receive a lower interest rate, better terms, more flexibility, more options. A person with poor credit applies for the exact same loan. Same amount, same purpose, different reality, higher interest, more fees, more restriction, more cost. And before somebody says, well, Derek, that's fair, they're a higher risk. Sure, from the lender's perspective, that's the argument. But look at the outcome. The person with fewer financial resources pays more to access the same opportunity. The person already struggling receives the more expensive version of the product. That is the poverty premium. Now, here's something that most Americans don't realize. The US is not unique in having credit reporting. Countries like Canada, the UK, Australia, Germany, and many others all use some form of credit history when evaluating loans. But America has taken the concept further than most. In many countries, your credit history primarily affects your ability to borrow money. In the US, that number can follow you almost everywhere. It can affect housing, insurance rates, utility deposits, cell phone plans, the interest rate on your car, the interest rate on your home, and in some cases, even employment opportunities. Think about that. A score originally designed to help lenders evaluate loans has expanded into a number that can influence huge portions of a person's life. One number starts following people through adulthood like a financial shadow. And the lower that number gets, the more expensive everything becomes. Now, to be fair, credit scores do serve a purpose. Lenders need a way to evaluate risk. A bank making a 30-year mortgage wants some indication that it's likely to be repaid. That's understandable. But here's the question we almost never ask. At what point does measuring risk start creating more risk? Because if a person falls behind due to a layoff, medical emergency, a divorce, a family crisis, or simply a period of bad luck, their credit score can tank. Then borrowing becomes more expensive, housing becomes harder to obtain, deposits get larger, insurance costs more, opportunities become more limited, and recovering financially becomes more difficult. The system sees a higher risk person. The person experiences a higher cost of life. And sometimes those higher costs make it even harder to escape the original problem. That's the cycle. That's the trap. That's why credit scores have become one of the most powerful examples of the poverty premium in modern America. Because one of the strangest things about modern America is this: the people most in need of affordable access to opportunity often face the highest barriers to obtaining it, not because they lack potential, not because they lack work ethic, not because they lack ability, but because the system has decided they're expensive to trust. And then we get to banking. This is where things become almost absurd. Let's say you're living paycheck to paycheck. Your account balance is tight. A bill hits a day early. A paycheck arrives a day late. A transaction posts in a different order than expected. Suddenly, you're overdrafted. And now you're paying a fee because you didn't have enough money. Think about that. The punishment for not having money is losing more money. For years, overdraft fees generated billions of dollars for financial institutions, not from wealthy customers, not from people with significant savings, mostly from people living close to the edge. One mistake, one timing issue, one unexpected expense, and suddenly a small shortfall becomes a much larger problem. Then come late fees. Late fees are fascinating because they often create the exact opposite outcome they're supposed to prevent. Someone struggles to pay a bill. They get charged extra. Now they owe even more money, which makes it even harder to pay, which increases the likelihood they'll fall behind again. That's like trying to help a drowning person by handing them a backpack full of bricks. And then we arrive at one of the most notorious examples in America: payday lending. People need emergency cash. Cars break down, kids get sick, rent comes due, life happens. The problem isn't that people need short term loans. The problem is what some of those loans cost. Because when annualized interest rates climb into the triple digits, we're no longer talking about a helping hand. We're talking about survival becoming a business model. And here's where people often miss the bigger picture. Nobody wakes up and says, you know what sounds fun today? Taking out a payday loan. People use these products because alternatives are limited options, limited access, limited margin. Because when you have savings, an emergency is expensive. When you don't have savings, an emergency can become profitable for somebody else. That's the difference. Then we get to housing, and housing might be the biggest poverty penalty of all. People with money build equity. People without money often build someone else's equity month after month, year after year. And if you've ever tried renting with poor credit, an eviction history, or a limited rental record, you already know what comes next: larger deposits, application fees, additional requirements, higher barriers, more cost. Again, the people with the least flexibility are often asked to pay the most upfront. And then there are the neighborhoods themselves, because poverty doesn't just affect individuals, it affects geography, food deserts, banking deserts, limited transportation, fewer grocery options, fewer healthcare options, fewer financial services, fewer opportunities. And once access disappears, costs start rising. Because now you're driving further, paying more, waiting longer, choosing from fewer options, all of which have a cost, not just financially, emotionally, physically, professionally. And this is the part where the entire episode comes together. Most people think poverty means not having enough money, but increasingly, poverty means paying more money, more for credit, more for transportation, more for housing, more for financial services, more for emergencies, more for mistakes, sometimes more for simply because you ran out of margin. It's the key. The system doesn't just punish mistakes. The system often punishes a lack of margin. And those are not the same thing. A wealthy person can absorb a surprise. A working class family may feel it. Poor family may spend months recovering from it. The event is identical. The consequences are not. That's what makes people angry once they see it, because many of these costs aren't attached to bad decisions. They're attached to vulnerability itself, which brings us to the part people are living right now. Not history, not theory, not economics textbooks, real life. The everyday tax on being broke. Once we start stacking those examples together, the picture becomes impossible to ignore. Up to this point, we've talked about history. We've talked about systems. We've talked about incentives. Now, let's talk about real life, because this is where the poverty premium stops being an academic discussion, starts showing up in people's checking accounts every single day. Most Americans don't experience the poverty premium as one giant event. They experience it as a series of small financial cuts: one fee, one penalty, one higher price, one missed opportunity, one extra charge. By itself, none of them seem devastating. Together, they can feel suffocating. That's why so many people who are working full time still feel like they're running in place because they're not just paying for life, they're paying the penalty for having less margin. Let's start with banking again, because honestly, this one's one of the cleanest examples. Imagine your paycheck hits on Friday, your utility bill processes on Thursday. You're short by $20, not 200, not 2000, 20. Now you're overdrafted. The fee gets added. What started as a $20 shortage becomes a $50 problem, or a $70 problem, or a $90 problem, depending on how many transactions hit. And here's the part that should make people angry: nobody charges wealthy people a fee for having money. The penalties almost always flow in one direction, toward the people already struggling. Then there are late fees. Let's be honest, America loves late fees. We have late fees for bills, late fees for rent, late fees for credit cards, late fees for utilities, late fees for library books, late fees for everything short of breathing. And sometimes those fees make sense. Rules matter, deadlines matter, responsibilities matter. I'm not arguing otherwise. But if somebody is already behind financially, adding another financial burden doesn't usually solve the problem. It often makes the problem much worse, which means the fee becomes less about accountability and more about revenue. And those are not the same thing. Then we get to one of my favorite examples because it's so absurd: buying things in bulk. People with money save money. People without money often can't. A family with extra cash buys the giant package, the warehouse club membership, the bulk discount, the family sized option, the lower price per unit. A family living paycheck to paycheck buys a smaller package, not because it's cheaper, because it's all they can afford today. By doing so, they often pay more per ounce, more per item, more per use. Again, the person with less money pays more for the exact same product. It's like the economy looked at financial instability and said, we should probably add a surcharge. And then there's transportation. This one hits working people especially hard. A reliable vehicle creates options, job opportunities, flexibility, access, time savings. An unreliable vehicle creates expenses, repairs, missed work, lost income, emergency borrowing, stress. And here's the cruel part: people with money can often fix a problem before it becomes catastrophic. People without money frequently have to wait, which means a $300 repair becomes a $1,500 repair. Not because they ignored it, because they couldn't afford to address it when it was smaller. The exact same thing happens with healthcare. We've already talked about that. Small problem becomes a larger problem because treatment gets delayed, not because people don't care, because they don't have margin. Then there are food deserts. And if you've never lived in one, count yourself lucky, because when grocery stores disappear, people don't stop needing groceries. They just end up with worse options, more expensive options, less healthy options. A wealthy suburb may have multiple grocery stores competing for customers. Prices stay competitive, selection improves, choices expand. A struggling community may have one option, or none, or maybe a Dollar General, which means residents travel further, spend more on transportation, pay convenience markups, or rely on stores that were never designed to provide affordable, healthy food in the first place. Once again, less access, higher costs, same pattern. Then we arrive at what might be the most frustrating example of all: interest. Because rich people and poor people both pay interest, but usually in very different ways. People with wealth often earn interest: interest on investments, interest on savings, interest on assets, money generating more money. People struggling financially often pay interest: interest on credit cards, interest on emergency loans, interest on vehicle financing, interest on survival. And that's the line I want you to remember from this entire section. Rich people earn interest, poor people pay interest. Or to put it another way, rich people pay interest on opportunities. Poor people often pay interest on emergencies. That's a completely different experience, a completely different relationship with money, and a completely different reality. Because once you start seeing all these examples together, a larger truth emerges. The poverty premium isn't one policy, it isn't one industry, it isn't one bad actor. It's 1,000 different systems all nudging in the same direction, charging more, adding friction, creating barriers, making recovery harder. And eventually, you have to ask a question. If hard work is supposed to be the pathway out of poverty, why do we keep making the climb more expensive for the people doing the climbing? Now we get to the receipts because everything we've talked about so far can sound like an opinion. It can sound like perspective. It can sound like ideology, but the numbers don't care about ideology. The numbers don't vote. The numbers don't watch cable news. The numbers simply tell us what's happening. And what they are telling us is uncomfortable. Let's start with payday lending. Because if you are trying to design a product that keeps people financially trapped, it would be hard to do much better. Many payday loans carry annual percentage rates that can climb into the triple digits, not because people are borrowing huge amounts of money, because they're borrowing small amounts of money under desperate circumstances, few $100s, a car repair, a utility bill, rent, groceries, life. Think about that. If a wealthy investor borrowed money at 400% interest, we'd call it insanity. When a struggling family does it, we call it a financial product. And before somebody says, well, nobody forces people to take payday loans, that's true. Nobody forces people to use life rafts either. But if you're drowning, your options look different than they do from the shore. Next up are overdraft fees. For years, banks collected billions of dollars annually from overdraft fees. And here's the important part: the revenue isn't spread evenly across all customers. Research constantly found that relatively small percentage of customers generated a large percentage of overdraft fee revenue. In other words, the people struggling the most were often paying the most. Again, the penalty for not having enough money was losing more money. Let's talk about housing, because housing might be the biggest poverty penalty in America. Financial experts generally recommend spending no more than about 30% of income on housing. For millions of Americans, that's not even remotely realistic. Many renters spend significantly more, 40, 50%, sometimes even more. Once housing consumes that much income, everything else becomes harder. Saving becomes harder. Emergencies, retirement, and recovery all become harder because margin disappears. And when margin disappears, every setback becomes more dangerous. Now, let's zoom out because the individual examples are powerful, but the bigger picture is even more important. Every one of these systems has its own logic. The lender says they're pricing risk. The bank says they're enforcing account rules. The landlord says they're protecting against loss. The insurer says they're managing exposure. The utility company says they're reducing defaults. And taken individually, some of those arguments make sense. But when you stack them all together, something remarkable happens. The same person gets charged extra by the bank, the lender, the landlord, the insurer, the utility company, the financing company, the credit card company, sometimes all at the same time. That's when the poverty premium stops looking like a collection of isolated decisions, starts looking like a system where financial vulnerability becomes a revenue stream, a system where instability becomes profitable, a system where the people with the least room for error are often charged the highest price for making one. If that sounds harsh, consider the alternative explanation that all of these outcomes are purely accidental, that every fee, every penalty, every market, every higher rate, every additional cost just happens to land on financially vulnerable people by coincidence. I don't think that's what we're looking at. I think we're looking at a system doing exactly what it was designed to do. The problem is that what makes sense for the system doesn't always make sense for the people living inside of it. That's where we need to have a serious conversation. Because if we can identify the problem, we should probably talk about solutions, not charity, not handouts, not magical thinking, real reforms that make it easier for people to climb the ladder instead of charging rent for every rung. And that's where we're headed next. Now comes the part where somebody says, okay, Derek, we've spent the last 40 minutes explaining why the system is stacked against people who are struggling. What exactly are we supposed to do about it? Fair question, because identifying the problem is important. Fixing it is the point. And before we go any further, let's clear something up. This conversation is not about making poverty comfortable. It is not about eliminating personal responsibility. It's not about pretending choices don't matter. Choices matter. Decisions matter. Responsibility matters. Anybody telling you otherwise isn't being serious. And here's what also matters: a system should not make recovery harder than failure. And that's exactly what happens too often today. Because if somebody gets knocked down financially, the system frequently responds by attaching additional weights to their ankles: higher fees, higher interest, larger deposits, more barriers, more restrictions, more cost. That doesn't encourage recovery, it slows it. Sometimes it prevents it completely. And honestly, one of the easiest ways to judge any policy is to ask a simple question: does this help people climb out of a hole, or does it make the hole deeper? Let's start with banking, because some progress has already happened here. A number of banks have reduced or eliminated certain overdraft fees. Some credit unions have created small dollar loan alternatives. Some institutions have recognized that repeatedly charging struggling customers isn't a large term growth strategy. It's just a transfer of wealth from people who don't have it to people that do. And that's a lesson worth expanding, because access to safe, affordable banking should not be considered a luxury. It should be considered basic infrastructure, just like roads, just like electricity, just like clean water. Modern life is almost impossible without access to the financial system. Now, let's talk about small dollar lending, because here's the reality: emergencies are always going to happen. Cars will break, kids will get sick, water heaters will explode at the worst possible moment. Life doesn't care about your budget. The solution isn't pretending people won't need emergency loans. The solution is making sure those loans don't become long term traps. Because there is a massive difference between helping someone survive an emergency and profiting from their emergency. Then we need to talk about housing. Let's be honest, housing has become one of the biggest economic pressures facing working Americans. Not just poor Americans, working Americans, middle class Americans, young Americans, retirees, everybody. If housing costs continue to absorb larger portions of household income, financial stability becomes harder to achieve regardless of what someone earns, which means we need more housing, more affordable housing, more starter homes, more options, more supply. Because when housing becomes scarce, the people with the least leverage usually suffer first. And then there's transportation. And this one gets overlooked all the time. Reliable transportation is not a luxury in most of America. It's a prerequisite for participation. You need transportation to get to work, to get to school, to get to medical appointments, to access opportunity. When transportation fails, opportunity often disappears with it. And that means communities need better access, whether that's public transit, infrastructure, walkability, or simply ensuring people aren't one transmission failure away from financial collapse. Then we need to talk about credit, because while lenders absolutely need ways to evaluate risk, we should also be asking whether people have realistic paths to recovery. One of the most frustrating parts of the current system is how long mistakes can follow people: a medical crisis, a layoff, a divorce, a period of unemployment, a family emergency. Sometimes a person can spend years recovering from an event that lasted a few days. A healthy economy should reward recovery, not permanently punish hardship. And maybe that's where I want to spend the rest of this segment, because I think we've been asking the wrong question. People often ask, how do we eliminate poverty? That's a huge question, a complicated question, a question every society has wrestled with. But maybe there's a smaller question we should ask first. Why do we keep making poverty more expensive? Because that's something we can actually address. We can reduce unnecessary fees. We can improve access to banking. We can expand affordable housing. We can improve transportation. We can create safer lending alternatives. We can make it easier to recover from financial setbacks. None of those things guarantee success, and they shouldn't. Success still requires effort, discipline, responsibility, hard work. All of that matters, but the goal should be creating a system where effort has a chance to work, where one mistake doesn't become 10 mistakes, when one emergency doesn't become a 5 year setback, where one bad month doesn't trigger a cascade of penalties that takes years to escape. Because that's what so many Americans are really asking for, not special treatment, a fair shot. And maybe that's a line I keep coming back to throughout this entire episode. The goal isn't to make poverty comfortable. The goal is to stop making it profitable. Because when financial hardship becomes a business model, we shouldn't be surprised when hardship becomes harder to escape. And if we're serious about creating opportunity, the first step is making sure people can actually reach it. Up next, hold 'em or fold 'em. And tonight, we're folding some of the most expensive traps in the American economy. You know the rules. If it helps people build stability, create opportunity, and climb the economic ladder, we hold them. If it traps people, exploits financial vulnerability, or turns hardship into a revenue stream, we fold them. Tonight, we're folding some of the most expensive traps in the American economy. Let's begin. Let's be clear, needing emergency money is not the problem. Emergencies happen. Cars can break. Kids get sick. Hours get cut. Life punches people in the face sometimes. That's reality. The problem is when the emergency lending becomes a long term business model built around repeated borrowing. When somebody borrows a few $100s and ends up trapped in a cycle of fees and interest, we're no longer solving a problem. We're monetizing desperation. And honestly, that's the theme of tonight's episode. A lot of these industries don't profit because people are thriving. They profit because people are struggling. Fold it. I've never understood this one. You don't have enough money, so the solution is to take more money from you. Somewhere, somehow, that became normal. Now, I understand banks need rules. I understand accounts need limits. I understand institutions need to manage risk. But there's a difference between accountability and punishment. For years, overdraft fees cross that line. If a system generates billions of dollars primarily from people already living on the edge, maybe the problem isn't the customer. Maybe it's the business model. Fold it. This one is sneaky because it looks affordable. Small weekly payments, manageable monthly payments, no credit needed, no problem. Until you do the math, and suddenly that couch costs twice what it should. That television costs twice what it should. That appliance costs twice what it should. Again, the people with the least money end up paying the highest price. It's not opportunity. That's a poverty tax wearing a friendly smile. Fold it. This one needs a little context because one of the most overused phrases in American politics is pull yourself up by your bootstraps. The funny thing is, it's not what the phrase originally meant. Originally, it was used to describe something impossible. Think about it. Try literally pulling yourself up into the air by grabbing your own shoes. You can. That was the joke. The phrase was meant to describe an absurd task that couldn't be accomplished through individual effort alone. Somewhere along the way, we completely flipped the meaning. Now, it's often used as a way to suggest that success is purely the result of personal effort, and failure is purely the result of personal shortcomings. Now, let me be clear. Personal responsibility matters. Hard work matters. Discipline matters. Good decisions matter. Nobody is arguing otherwise. But if success were simply a matter of effort, every exhausted single parent would be wealthy. Every person working 2 jobs would be financially secure. Every family dealing with a medical crisis would somehow power through it with determination alone. Life does not work that way because people don't exist in a vacuum. They exist inside systems, schools, roads, communities, families, employers, healthcare systems, financial systems, economic conditions. All those things matter. And that's before we even talk about circumstances, a layoff, a disability, a medical emergency, a divorce, a family crisis, bad timing, bad luck, things that happen to people every single day. The reality is true success is rarely a solo act. Even the most successful people can usually point to teachers, mentors, friends, family, employers, coworkers, communities, opportunities. Somebody opened a door. Somebody offered support. Somebody provided a chance. Because we live in an interdependent society, not an independent one. The food in your grocery store exists because of thousands of people you'll never meet. The electricity in your home depends on people you've never met. The roads you drive on, the internet you're using, the healthcare system, the banking system, the economy itself. None of us succeeds entirely alone. None of us fails entirely alone either. That's why the bootstrap myth is so dangerous. Turns every success story into an individual story, every struggle into a personal failure. It ignores systems. It ignores barriers. It ignores circumstances. It ignores reality. Keep the responsibility. Keep the work ethic. Keep the discipline. Fold the myth. There's a difference. Credit unions don't solve every problem, but they often provide something that many large financial institutions struggle with: community focus. Because unlike publicly traded banks, credit unions are member owned. That can create incentives that look very different: lower fees, better services, small dollar lending options, a relationship instead of a transaction. Again, not perfect, but generally moving in the right direction. Hold it. This one shouldn't be controversial. Markets need rules. Nobody would watch a football game without referees. Nobody would play poker without the rules. Nobody would invest in a market where fraud was legal. Consumer protections exist because history repeatedly shows what happens when there are no guardrails. And spoiler alert, it usually ends with someone getting rich and someone else getting robbed. Hold it. Now, let me be careful here. Financial literacy is not a cure for poverty, and anybody claiming it is overselling it. You cannot budget your way out of a structural problem, but financial literacy absolutely matters. Understanding interest, credit, debt, investing, understanding how money works, those things matter. Knowledge doesn't eliminate every obstacle, but it can help people avoid some of the traps. Hold it. This is probably the least exciting advice I'll ever give. It might be the most important. Margin matters. In fact, if you've watched this entire episode, you might have noticed something. Almost every poverty penalty we've talked about tonight starts with the same problem: no margin. The car breaks down, no margin. The medical bill arrives, no margin. The hours get cut, no margin. The appliance dies, no margin. And suddenly a manageable problem becomes a crisis. Now, let me be honest with you. This one hold I struggle with myself. I'm not sitting here pretending I've mastered it. Life happens. Unexpected expenses happen. Medical issues happen. Family responsibilities happen. Sometimes building an emergency fund feels like trying to fill a bucket with a hole in the bottom. So if you're watching this and thinking, easy for you to say, Derek, trust me, I get it. Probably more than you even realize. But here's why I'm still holding it: because every single dollar a margin changes the math, not all at once, but gradually. A flat tire becomes annoying instead of devastating. Surprise bill becomes stressful instead of catastrophic. A bad week stops becoming a bad month. Bad month stops becoming a bad year. That's the real value of savings. It's not wealth, it's breathing room, it's time, it's options, it's flexibility. It's the ability to absorb life's punches without immediately falling into a financial hole. And if tonight's episode has taught us anything, it's that margin is often the difference between a setback and a spiral. That's why it gets a hold, even from somebody who's still working on it himself. So tonight's scorecard: fold payday lending traps, fold excessive overdraft fees, fold rent to own schemes, fold the myth that hard work alone explains every outcome. Hold credit unions, hold consumer protections, hold financial literacy, hold emergency savings. Because the biggest lesson from tonight isn't that people don't need responsibility. It's that responsibility works best when people actually have a fair chance to succeed. That brings us to the most important part of tonight's conversation, because this episode was never really about payday loans or overdraft fees or credit scores or rent to own stores. It was about opportunity. What happens when opportunity becomes more expensive for the people who need it most? There are some episodes where the conclusion is complicated. This isn't one of them, because after everything we've talked about tonight, one fact still remains impossible to ignore: being poor is expensive. And honestly, that sentence should sound ridiculous. It should sound so backwards that nobody believes it, yet millions of Americans live it every day. Think about what we've covered. The person with better credit gets the lower interest rate. The person with savings avoids the payday lender. The person with cash buys in bulk. The person with resources absorbs emergencies. The person with margin gets options. Meanwhile, the person with less money often gets higher cost, more fees, worse terms, fewer choices, more barriers, and less room for error. And that's what bothers me. Not that life is unfair. Everybody knows life is unfair. Life has always been unfair. The problem is when our system starts amplifying that unfairness, when they start taking difficult solutions, making them harder, when they start turning vulnerability into a business model. Because let's be honest, most Americans are not asking for guaranteed outcome. They're not asking for a guaranteed house, guaranteed retirement, a guaranteed income, a guaranteed life. They're asking for a fair shot, a chance, an opportunity, the ability to move forward without being charged extra for every stumble along the way. That's where I think we've lost the plot because somewhere along the way, we stopped asking whether a system creates opportunity, started asking whether a system creates profit. Those are not always the same thing. A payday lender can be profitable. That doesn't mean it's creating opportunity. An overdraft fee can be profitable, but that doesn't mean it's helping people recover. A rent to own contract can be profitable. That doesn't mean it's building wealth. Profit and value are not identical concepts. And when we confuse the two, people get hurt. What makes this issue so frustrating is that many of the people paying the poverty premium are doing exactly what we've told them to do. They're working, they're trying, they're raising families, they're paying bills, they're showing up. And before somebody says, well, some people make bad choices, of course they do. We all do. Every single person watching this has made a bad financial decision, including me. The difference is that when somebody with money makes a mistake, it's often an inconvenience. When somebody living on the edge makes a mistake, it can be a crisis. A late payment becomes a fee. The fee becomes a larger balance. The larger balance becomes debt. The debt affects credit. The credit affects housing. The housing affects opportunity. And suddenly one mistake has consequences that last years. It's not accountability. That's compounding punishment. Those are not the same thing. The truth is, most people are closer to financial hardship than they like to admit. A job loss, a medical emergency, a disability, a divorce, a family crisis, a major repair, a natural disaster. Life has 1,000 ways of humbling us. That's one reason I think this episode matters, because poverty isn't some distant thing that only affects other people. For many Americans, poverty is not an identity, it's an event, sometimes a temporary event, sometimes a permanent one. But often the difference between stability and struggle is much smaller than we'd like to believe. And that's why I reject the idea that this conversation is about charity. It isn't. It's about opportunity. It's about whether we want systems that help people recover or systems that profit from their setbacks. Because if you truly believe in hard work, if you truly believe in personal responsibility, if you truly believe effort should matter, then you should also believe people deserve a realistic opportunity to succeed when they make the effort. Otherwise, we're not rewarding work. We're rewarding starting positions. Those are two very different things. At the beginning of this episode, I said that poverty comes with fees. Poverty comes with penalties. Poverty comes with interest. Poverty comes with worse options. After tonight, I hope you see something else. Poverty also comes with assumptions. Assumptions that people are lazy. Assumptions that people don't care. Assumptions that people simply didn't try hard enough. Those assumptions often blind us to the systems sitting right in front of us. Because when someone is carrying a backpack full of fees, penalties, interest, barriers, and bad luck, telling them to simply walk faster isn't a solution. It's an excuse not to look at the weight. The goal isn't to guarantee success. The goal isn't to eliminate responsibility. The goal isn't to make poverty comfortable. The goal is to stop making poverty more expensive. because a society that charges people more because they have less should not be surprised when fewer people can get ahead. And a country that believes in opportunity should be asking itself a simple question: why do we keep making opportunity more expensive for the people who need it the most? So stay informed, ask questions, and as always, hold them accountable.